All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. As I went out and kind of did my normal research ahead of, an earnings period and, some of the things that I'm looking for and that I want to see and or information that I want to gather. I kept in mind, all right, how do I kind of communicate, kind of this earnings element going into this quarter. Every quarter is just a little bit different, and it's always evolving and changing. And what does the market what is the market keying in on, and what are those elements that are going to matter when it comes to this earnings season? Because let's face it, right? Let's face it. We can go out, do all the homework we want, and go, well, is this stock going to go up or down after earnings, right? And let's face it, it's a coin flip. And yes, there are certain trades, there are certain earnings reports where yes, you can get a little bit of an advantage. And when I feel I have that, I will trade those. And there are others where I will just trade because, well, you know what? It's the same thing as buying a lottery ticket, right? But I don't really have any extra special insight into what is going on and how the market's going to react to it, and the data that will be produced. And so, okay, going into earnings season, what am I looking for? What am I trying to gather from the market? And, for me, it's pretty simple. I'm not looking for much. I'm really not. I kind of look at this earnings period and this earnings season as one that isn't hypercritical. Meaning it's not, it's not going to be all telling. It's not going to be all, all defining for the market. And most earnings seasons aren't. Most earnings seasons are just, it's an earnings season. But what could change that, right? What could happen that could create some pretty dramatic change in the market? Because I do believe that the market is set up for that potential. Okay, not potential that's being realized, but set up for that potential. And, when you look at the incentives of those in power around the world, right, the incentives from the Fed to heads of state, the incentives are still to push the markets higher. And so, that has to be taken into account. But regardless of incentives, what could change that would drive investors out of the market? Because we are in a market right now that investors have been forced into. Now, a lot of that forcing has paid off. So it's not like investors are super eager to jump on out, right? We talked about this kind of forced element back here in January and then into February, and they've been paid off. They haven't had to look at big red losses on the board and go, oh well, you know what, I've got to just jump out and clear my board. No, they've been paid off very nicely. So they're not in a position where they have to jump on out. In fact, they're in a position where they need to get more, right? And so, all right, this earnings season, let's face it, it's not like one earnings report's going to make or break anything or sway the global markets one way or the other. We will, like normal, get insight into specific industries and specific businesses that could be doing things a little bit differently, or things that are up and coming, or things that are that are lagging and in trouble. But bottom line, what would have to happen to see real change come to the market based on the earnings season? Because we know long-term markets are driven by earnings and economics, right? Long-term. And we have seen a divergence here in the earnings and economics and the market, right? We have seen the earnings and economics dropping or weakening, okay? They're not negative, but their growth rates have been weakening while the market itself has been going up. We haven't had this type of divergence in many, many years. This is a new thing. This is a brand new thing for the market to deal with. The last time I remember this big of a divergence was Q3 of 2007. And, it was one of those quarters where, the market was kind of Teflon. It just said, nope, the Fed's now on our side, so nothing's going to go wrong. Everything's going to go right from now on. Subprime, it's not a thing because, well, it exists, but, it's not going to matter because, everybody knows how to fix it, right? And we know how that, ultimately turned out. But right now the market's in that mode. The market's in that Teflon mode of, there are problems. There are issues. And, the growth rate's going to go down. And, we could be staring at a global recession if a few things go. But you know what? We have a magic pill, silver bullet, whatever you want to call it, to go. So what would have to happen to change the current conditions or the current mentality of the market as a whole? One earnings report isn't going to do it, but what would have to happen for the earnings season to be that catalyst? And so as we go and preview earnings, that's the idea that I'm going to go on. What would have to happen? Now, I think the odds of this happening are pretty slim. Okay? I think the odds of this happening are relatively slim. And so that's one of the reasons why I don't think this earnings season is going to be all that, big a definer for the markets. But what would have to happen to change that? And I think there's a legitimate potential for it. And so let's go out and take a look at that. If this doesn't happen, right, then you know what? It's kind of same old normal earnings season. And, most earnings seasons after a big run or a big drop or consolidation periods, right? That's what most earnings seasons are. But obviously, if this happens, it could be a little bit different, all right? If you want the numbers, you've seen me kind of post this before, but FactSet Earnings Insight. Just type it into Google, and it'll bring up FactSet Earnings Insight, and it'll bring up this PDF. And every week they update the numbers, right? And we go through the estimated earnings decline for the S&P is 3.9%, right? When's the last time we've been talking about an earnings decline? Let alone a market sitting at a brand new high or close to a brand new high with an earnings decline. Yeah, it's interesting, right? We had an earnings decline in 2016, but market wasn't sitting near new highs or anywhere close. So, you can come into the numbers, look at the valuations, look at the different graphs and everything else of where things sit. And you've seen me go through this in past quarters. I'm not going to bore you with that here today because I don't think it's all that relevant. Because let's face it, this market right now is not staring at these numbers and making decisions based on these numbers. There is an additional factor out there driving things that isn't based on these numbers. So I'm going to go to a different website. I'm going to go to Estimize because visually we can kind of see what's going on. And there are companies like Apple that are going to report earnings. Everyone's going to talk about them. And when we come in and we look at the earnings on Apple, you'll see quarter over quarter, they ebb and they flow. This chart here, what it shows is what Apple's earnings have been and versus what the expected was, right? And every quarter is posted here. And one of the things that's important as we look at these charts is the fact that not these hills and valleys, because these will happen quarter over quarter over quarter, but whether they're growing. So here, if we go every first quarter of the year, we've continued to see earnings growth, right? Every third quarter of the year, we've seen earnings growth. That's this time it's expected to be earnings loss, right? So what is it? How does it compare quarter over quarter? And I'm not going to go to earnings because I don't think it matters. I'm going to go to revenue. This is what's going to matter this quarter. This is the only thing that is going to shake the markets into understanding what's going on out there or that there's potential danger out there. It's not going to be earnings, because earnings, they're just going to go, well, yeah, the market will justify it in this environment. The only thing that will shake it is revenue, and the one thing that falling revenue will do is it will shake margins, and the one thing that shaking margins will do is it will shake outlooks going forward and put them a little more in line with what the IMF said here this morning. Do we really care about someone like Apple? Apple has, kind of been in multiple years of, just kind of, there's revenue growth here and there and pop and drop, but this isn't one of your big growth companies out there, right? This isn't, Apple's earnings aren't going to shake the market one way or the other in a major way, okay? Could they drive it on that day in some sentiment? Sure. Same way with Ford. Ford, if you look over the last 3 years, and you look at the revenue over the last 3 years, Ford has not been driving the markets higher. Right? Ford has been up and down and all around when it comes to revenue. There's no real trend here. But there are many companies out there that have long-term, multi-year trends intact of sustainable, solid revenue growth, and the expectations are for that to continue. Let's take a look at a few examples. Here's Visa. I mean, it's just revenue growth. If we go every we compare year over year, right? And we take and go, okay, here's last quarter. Well, the expectation for, the same quarter of 2020 is for growth. We look at this quarter coming up right now. Here we are. Well, the last quarter, the comparable quarter, was right down here. We're talking about big growth in revenue here with Visa. And there are a lot of these out here in the market. For the market to go into a bearish mode and go into a bear market, a sustainable bear market, the revenue trends of companies like Visa have to be knocked off. The bears have to capture something here. If they don't, market's not going to. Yes, the market will have maybe a correction or a 5 to 10% sell-off, but we're not going to be talking about any big, bad bear market. I want to show you the ones that I'm watching the closest. Visa's one of them. And within the financial group, I'm watching Visa and JP Morgan. These have been two companies where revenues have just been on the rise, where they've just been growing quarter over quarter, year over year. Now, you can see revenue has fallen off here for JP Morgan over the last little bit, right? But you can see what the revenue expectation is here this quarter. It's not quite for growth, but we're still talking about year over year growth, consistently here for JP Morgan. JP Morgan, Visa. Do they continue to beat on revenues? Do they continue to show this revenue growth? Those are the two I'm most interested here in the financial space. But I don't think the financial space is going to be the biggest driver here. Because, let's face it, if the financials drop on earnings, right, it'll just be blamed on the Fed. And, well, okay, the Fed just did this, and they made things a little easier. So, that does put some pressure on bank earnings, but it also makes the rest of the economy better. So, things will be fine. Yeah, banks will sell off, but the rest of things will be, fine. And that could be washed away. That could be kind of reasoned away. So I don't think the banks are going to be the big driver. I don't think they're going to be the key when it comes to looking and saying what's the ultimate market reaction going to be here to earnings. I think the two spaces that will be are the industrials and tech. Industrials and tech. Let's start with industrials. Here's UTX, United Technologies. Great company. Again, I don't care about earnings, but take a look at revenue trend. Right? I mean, this is a Visa revenue trend. They just continue quarter over quarter, year over year, continue to grow revenue. If this starts to break, if we're talking about a revenue miss or a revenue guidance that takes down some of the expectations here in 2020, we're talking about trouble. CSX, railroad, same thing. It's been a company that's just been revenue growth, revenue growth, revenue growth. If we see revenue guidance taken down or big revenue misses, trouble. Then there's Caterpillar. And these are the three that I'm watching the closest. Again, I don't care about earnings. I mean, last quarter, Caterpillar earnings missed. Okay, fine, whatever. What about revenues? Caterpillar's revenues have been on the steady decline here. Steady incline for a while. If it stays like this, market's going to, celebrate new highs and keep going higher. This is what has to break for the bears to take control in the environment that we are in right now. UTX, Caterpillar, and CSX. Now, we may see this from one and not the other, or two and not the third. It's not necessarily you're going to see all three do the same thing at the same time, where you have to have all three. But these are the three that I'm watching the closest to say, hey, you know what? Do we see a change in terms of revenue expectations with these companies? With tech, there are quite a few that I think are interesting. I don't think semiconductors are going to matter. I don't think some of the smaller cap tech like Twilio or something like that is going to matter all that much. I think it's some of the tech sentiment stocks and some of the ones like a Netflix. And Netflix has been a revenue monster here for a long time. And you could see the expectations are for revenues to continue to grow at an incredible pace. If we see Netflix cut their revenue projections, I don't think it would be a Netflix story. I think it would be a more global economic story. And so that's why I'm watching Netflix. Now, we could have Netflix go down $30 on earnings, yet their revenue trends stay the same. Right? Because the market's going to be looking at what are the subscribers doing and what about competition and all these other factors. So I'm looking at Netflix not to say, well, is Netflix going to go up or down? And they're going to go up if revenue beats and they're going to go down if revenue misses. But no, if they lower revenue guidance going forward, we're not talking about this steep incline of revenue growth, we could still see Netflix go higher, but that would not bode well for the overall market. The other one is Google. And Google has kind of been very similar to Netflix in terms of revenues. And you can see the revenue growth here with Google. It's monster. It continues to be an absolute revenue growth monster out there in the market. These are the things that the bears have to take down to have a really solid argument. And these are the things the bears were not able to take down in Q1 to, give them a really solid earnings argument when it comes to, hey, you know what, the market's got to collapse because blah, 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 right? And we talked about it over the earnings season, and the bears did not get what they wanted. But these are the things that they need to see. And then the last one is Amazon, who has also been an absolute revenue monster. And, Amazon's broken down into a couple parts anymore, when it comes to, the shopping and the Amazon Web Services and everything else. But, we have a company that, we have a company who first quarter of 2017, their fourth quarter, did $60,000 in revenue. And 2 years later, almost 50% growth in that revenue. Just monster number. Just absolute monster growth, from Amazon. So these are the ones that would have to see some misses or have to see some of these revenue expectations drop. And of these stocks, UTX, Caterpillar. Sorry, I didn't show one here in the industrial group. Let me show it here. UPS is the third one in the industrial group that I'm watching. This is just kind of, had a very Amazon-like revenue trend. right? But overall, UPS, CSX, Caterpillar, and then within the within the tech space, the Amazon, Google, Netflix arena. Now you could take any company that has this type of look, this type of revenue monster, revenue type of trend here, right? I mean, we could come in here to a Boeing, and we could come and look at the revenue trend with Boeing, and it has been a monster, an absolute beast, right? When it comes to the revenue trend. I'm not watching this one as closely because they have some other issues kind of going on right now. Kind of affecting them. You take a look at something like a Disney. There's some acquisition type of stuff, so you're going to see a big revenue pop or expected revenue in Disney take a big jump here. And, that's because of some of the acquisitions that they have made. I also think this is going to be a positive driver for the stock overall, and that, we could be talking about Disney being a big beat on earnings and a big gap up on earnings when they report. And one of the ones I'm looking to play, I don't normally play Disney earnings other than, the shares, but this is one I think could really see a big pop on earnings. But this is later in the earnings season. But you could take any of these companies that have these big revenue growth type elements and take a look and say, hey, you know what? If they're talking about revenues coming down, there's going to be the catalyst for fund managers to say, you know what? I can't do it. Can't justify these valuations if revenues are not growing. If the revenues continue to be this strong for the Amazons and the Caterpillars and the Netflixes of the world and the Visas of the world and the UPSs of the world, if the revenue growth continues to be this strong, the way we see the market overall, the picture that the overall market has and the dynamics that it has, will be plenty good enough to keep the market going higher. And so the Bears are going to need a major change in the macro story, meaning, they're going to need some sort of breakdown in China-U.S. talks or something of that nature. Or, we could list a million things that could happen, but they would need one of those major catalysts to change the mindset, to change the tone in the market. Outside of that, the market tone isn't going to change. We're not going to look at this earnings season and go, well, that was a big pivotal earnings season because of X, Y, and Z if revenues don't change. If revenue expectations remain the same, we will see the overall market continue to tick higher. We will see, yes, some stocks drop and some stocks pop, as we always do, right? We'll have one of those days that'll look really funny. We have one every quarter where, the top 10 major stocks that reported are all down big and the market's up, right? We'll have some of those days here this earnings season if revenues are not, an issue. But I think this is the area where there could be an issue, especially revenue forecasts going forward. And if we do see that come in, that's the bear argument. If we don't see that come in, bears still have very little to stand on. And, they still have very little to hope for and to expect. They can, look at overbought and all of that and, look at valuations and all of that. But, bottom line is, market valuations have been elevated for a long period of time, and they will likely remain so. Now, there's an outlier group that's going to affect the earnings aggregate numbers and could make them look better or worse than expected, and that's energy. And as you look at the market and as you look at the aggregate numbers as they come in, keep in mind energy could skew things pretty good, pretty big. It's one that a big boost in energy isn't going to be all that bullish for the market. A big drop isn't going to be all that bearish for the market, and could skew some of the data. And that's why you don't see me have energy or even materials, associated here. Healthcare could have a little bit more of an effect as, fund managers are heavily involved in that space. But that's typically not going to be an economically sensitive area. That's more of a population growth trend type of area. And, but the financials to some degree, but to the majority of the degree, tech and industrials to me are going to be the most important areas when it comes to this earnings season. Now, individual stocks, I mentioned Disney, that I'll be looking to play higher, kind of going into the earnings. I also think Chipotle, with where it is right now, this could be a very interesting earnings play when it comes, as long as it doesn't rally into earnings. If it rallies into earnings, I don't want anything to do with the earnings. If it sells off or flattens through earnings, I think we'll be talking about an earnings pop, to the upside, given what some of the trends are out there in the market. Ford, I think we could be looking at a big gap down when it comes to Ford. When we look at what the earnings and the trends are and where the stock is and the valuations. They're one that may be a little overpriced for the news or for the information that is going to come out. I'm insanely curious about Bank of America, because we saw an earnings report that was so good right back here in January. So good. And, the stock hasn't gone anywhere since. The Fed kind of curbed its breakout, right? Bank of America started its breakout, hit 30, and then the Fed kind of, destroyed that. It has snapped back subsequently, but, you look at the yield curve, you look at who it doesn't benefit. It doesn't benefit Bank of America. And, back here on earnings right back here, this is a stock that, hey, the yield curve is going to normalize over time. The Fed's going to keep normalizing it. That was the momentum. Now, that's not the momentum. That's not the mentality of the yield curve. So I do expect Bank of America to have a pretty big move on earnings, and one that I'm more apt to want to play it to the downside given what's going on out there. But I'll take a look at it the day before, and if it's rallied a little bit, I'll probably look to play it on the downside. If it has sold off a little bit, I'll probably stay out of it. But those are some that I'm really interested in playing personally, and some of that just because of option values and things like that. I tend not to like to play Apple because options are kind of insanely priced around earnings. Netflix kind of insanely priced around earnings, so I tend to stay out of those. But when it comes to some of these others, the Disneys and the the Bank of America, they're not super dirt cheap, but they're not the way a Netflix is per se. All right. So hopefully that gives you a little insight into kind of what I'm looking at this earnings season, what I'm kind of expecting this earnings season. Bottom line, if you're a short-term trader, you just go with your charts and run with them. If you're an investor, for those of you who are, dealing with your retirement accounts and investing and everything like that, this is to me what you have to look for to say, hey, does the thesis change? And as long as those revenues don't pull back aggressively, or we're not talking about revenue cuts, the thesis isn't changing. Things like CSX and things like a Netflix and an Alibaba and an Amazon, they're still bullish going forward in the long run. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.